George, very good being here with you today. We had so many conversations with leaders from all over the world. Before we go to some questions, I want to start by asking you to introduce yourself and your company, please.
Sure. My name is George Nicholas, and I set up Shibui Capital just over 2 years ago. And I'm working with a lot of LPs and GPs, kind of bridging the gap, doing secondary acquisitions, co-invests, and continuation vehicles and recaps.
Very interesting.
Only in the hospitality industry.
Oh, you fully
just
focus on
just in
hospitality.
hospitality. Yep.
Very interesting. And we just had a conversation before in the plenary with almost 150 leaders, and hospitality sector usually, when I go back to 2018, 17 here, it wouldn't be so high, the preference of investors and players. And today it was on the second place
That's right.
in the preference.
Yeah, that's
How do you explain that?
So the question was asked, what sectors and what industries do you think are going to be the most advantageous over the course of the next 2 years? And data centers was number one, and hospitality was clear number two.
Yes.
I believe there's a good reason for that. I believe the fundamentals of hospitality business, the real estate business, has returned. But there's a lot of capital structure disruption still. So there's a lot of upside down balance sheets that needs to be worked through. So we have good underlying fundamental business, but broken capital structures that present opportunities for the investors.
Very interesting. And when you look at the challenges we have, we talk about geopolitical challenges, we talk about election, the US, China, et cetera, et cetera. What's your taking on that? Is there anything that will keep you up at night?
I sleep pretty well, but listen, I think hotels, like anything, aren't risk-free. I think office investors and people that have invested in traditionally low cap rate in real estate investments have also realized that those investments aren't risk-free. So we're seeing a compression of that delta between traditional long-term investment, the long-dated income investments the gap has closed between hospitality and those type of investments, which has forced portfolio managers to review their risk appetite and look to alternatives to try and understand where they can get a better value for money.
Is there any specific market that you think investors should consider more at the moment, that's more attractive at the moment?
So I've just come out of the plenary session that focused on hotels, and the consensus there was that the barbells are where people are focusing at the moment. So the barbells being luxury and budget.
Interesting.
And that's certainly a global phenomenon where luxury has really benefited from the repricing and is able to keep up with inflation. It has benefited from the tourism trends like revenge tourism we heard talked about, but then also budget. Where people are still on a budget, the cost of living crisis, cost of doing business crisis, if you will, is really focusing people to watch what they spend. So for the people that have a more elastic budget, then luxury is still attractive, and then people that are budget conscious, I think it's a good place to focus on the budget side as well.
Great. A final question. Let's exercise our capacity to predict the future here. Yep. Every year we come here in January, we ask which asset classes or what are the main challenges and so on. Next year, January 2025, what are we going to be talking about?
Oh, that's really hard to say. I mean, I do recall doing an interview just before, in January 2020, just before COVID. So COVID was a little bit of a noise, but the sentiment at the American Lodging Investment Summit, which focused solely on hotels, was still very positive without any focus at all on a potential pandemic coming out. So even with that brewing, the market was still very positive. So it is very hard to tell. What we do know is that the hospitality industry, as a result of the pandemic, was one of the most negatively affected. Owners lost a lot of cash flow during that period, relied upon government subsidies, and as a result, there's a lot of balance sheets that are upside down. So those are all being worked through. We've got great operators sitting on great assets that are no longer able to pull money out of the fund that it sits in, no longer to take money out of their debt from their debt provider because they're up, perhaps even breached LTVs, but very close to LTVs, and there's no appetite for lenders to provide more cash, certainly the senior lenders. So the opportunity I'm forecasting will come from a lot of the debt funds, a lot of the people looking to help those GPs plug the gap to do the ROI projects that they wanted to. These guys, generally, the GPs have been sitting on these assets for a couple of years, really sweating the assets hard over the COVID period. They've got great plans, and then they just need a little bit more time, a little bit more money. And I think the debt providers, debt funds, in the form of MES and PREF, will be a solution provider for a lot of those owners.
Perfect. George, thank you very much.
Yeah.